Hello everyone and welcome back to TradingView Snaps. My name is Tagatha and I'm going to be taking you through some of the highs and lows of what's been going on in the market this week so far. We're going to kick things off with a daily heat map, which as you can see in front of us is looking super mixed this morning. It's Thursday morning. Markets just opened about an hour and a half ago. Don't know why I looked at my hand. Don't have a watch on, but as you can see, things are looking rather mixed this week. If we slide down to a weekly heat map, slightly more promising, however, not nearly as good as the heat map was looking this time last week when we had a little check-in. And if we slide down to a monthly heat map, things are looking slightly more promising. A lot of lovely dark greens over there. However, Wall Street is still digesting all of the economic data that we have received lately, so there's no telling how the end of the month is going to go. Speaking of economic data, part of the reason we are looking so mixed today is because major US indices ended Wednesday, sharply down after the Fed released its July meeting minutes, which obviously, as you know, that is the meeting at which they put in place their second 75 basis point hike. So we all know how it ended, but it's interesting to see that in terms of the sentiment of the Fed, we've got a fair few officials who are thinking, we think that potentially we have to slow down on the rate hikes because we're not sure the economy can handle it. However, there are an equal amount, if not more, officials who are saying, no way, Jose, we need to do whatever it takes to bring down inflation. This, of course, all this is doing is adding to speculation, really. We have had so much economic data the last couple of weeks. We've had PPI, which is actually looking pretty good. We've had CPI, which showed inflation cooling to 8.5%. Core CPI as well is on the decline. However, we've still yet to get PCE, which is, in fact, the Fed's preferred measure of inflation. So we've basically got a whole bunch of news that everybody's trying to digest, everybody's trying to analyze. Everyone wants to know what the Fed is going to do in September. Ultimately, nobody does know. There is every single chance that they could surprise us either way. However, it is good to include this kind of thinking into your trading strategy for the next couple of months. This week has been packed round with retail earnings, but we're going to dive into that in a little bit, and we're going to have a little catch up on the commodities front. As you can see here, most commodities are either trading down or relatively flat. We've got gold, oil, copper and silver, all of which had rallies previously, except for oil, which has been on the decline since the beginning of June. All of them had rallies the last couple of weeks and are dipping into the red the last couple of sessions. The only standout in this space, interestingly, actually is natural gas, which, as you can see here, has been rallying. Yesterday, actually this morning, hit its highest prices ever. That can't be the case. Highest prices since 2008, and is up like 12% for the month or something. Let's double check that, shall we? 14% up, has continued to rally this morning. That is obviously, the cause of that is obviously the invasion of the Ukraine war and Russia's domination of natural gas supplies. Europe is feeling that particularly hard. Prices are up on both sides of the Atlantic, but Europe is feeling that particularly hard, obviously on the one part because of their increased exposure to Russia, but on the other hand, because the US has been slowly but steadily drilling shale gas for the last 15 years or so, which is basically fracking, and they've built up a nice little stockpile to avoid just such a case. But yeah, gas prices in Europe are sitting at about 10 times higher than they were before before Russia invaded Ukraine. And the worry here is that that is going to push the economy into a recession, which it narrowly avoided in the second quarter. But enough of that. We're going to dip into a little bit of retail earnings news. So people were actually a little bit nervous going into this retail earnings season because throughout the quarter we've heard like major neon red warning signs from a bunch of the big dogs like Walmart and Target, who we're going to touch on today, basically saying, look out guys, because the balance sheet is going down. So we're going to start chronologically, and that's handy because it means we get to start with the good news, and that is Walmart, who we heard from on Tuesday. Now, Walmart was obviously one of the big retailers that gave out two profit warnings during the quarter, saying that inflation was really changing the way people were spending and that was going to hurt them, which indeed it did. It did hurt them. People were buying way less of the high margin stuff like food and clothes and technology, and focusing more on necessities like food, which is understandable given all the stuff going on externally. However, what they didn't account for is the fact that a bunch of middle excuse me, bunch of middle class and higher class income earners were actually going to forego their Whole Foods and farmers markets and come in search of cheaper goods. And where did they go? They went to Walmart. That helped Walmart clear up a huge glut of inventory that they had sitting from like dating back to COVID days. And all those new shoppers helped sell off that inventory and helped Walmart bring in $152 billion in revenue, which is great for Walmart investors and brings us quite nicely onto Target. Oh, actually, before we get there, if we take a look at Walmart's chart, you can see it jumped 5% on its earnings on Tuesday, which is its highest price since its last earnings, which, as you can see, were not as promising. And it's more importantly managed to maintain those gains in the few sessions after. But back to Target. They unfortunately were not able to keep up with their namesake, and they did not beat any targets during the second quarter. In fact, they missed pretty dramatically on both ends of expectations and reported a 90% drop in profit, which is whopping and obviously not what any investor wants to hear. Inventory was their big problem. Once again, they were worried about how consumers were going to be changing their spending habits and how that was going to impact them. So what they did was they slashed all of their prices fairly severely because they figured that would get people to buy more stuff, which it did, and it will clear out that inventory that they had been inundated with the last couple of months. Obviously that hurt the balance sheet as they had warned it would, but they have defended their decision and said that whilst it's hurt the bottom line in the short term, it will guarantee, well, we don't like to say guarantee, but it will help ensure long-term profitability. So they've stood by that decision. Other earnings we've heard from retail earnings have been Lowe's and Home Depot, both of which have reported a little bit of a mixed bag, but ultimately have reported better numbers than anybody was expecting. But they again did reiterate that inflationary pressures had every chance of bringing down the balance sheet in the quarters to come. Hopefully, though, by the time we get to the Christmas rush and the economy is hopefully rebounding from inflation and war and COVID and etc., everything we've been dealing with the last couple of months, these big retailers will be ready to take the market by storm. Another popular retailer who actually reported a couple of weeks ago is Best Buy. Now, the reason we're talking about them is not because of their earnings report, but because of a little case of mistaken identity. So let's get into that. So let's take a look at, let's start with with Bed Bath & Beyond, shall we? So Bed Bath & Beyond, as you can see here, is rallying, skyrocketing, soaring, whatever word you want to call it. It is going to the moon. Retail traders have well and truly come back onto the scene, and Bed Bath & Beyond has been one of the major beneficiaries of that the last couple of weeks. It's up like 200% for August or something. Let's double check that. 260% for August, which is crazy even despite today's 21% losses. Part of that has been thanks to Ryan Cohen. Not sure if you've heard of him. He is the GameStop chairman, and he is a massive activist investor. His venture capital firm, RC Ventures, is actually Bed Bath & Beyond's second largest shareholder. And that's been going on the last couple of months. He's actually been getting pretty involved in the operational side of things, making all sorts of sassy comments towards the Bed Bath & Beyond CEO, Mark Tritton, and how he's not making the most of this boom of attention, I guess you could call it. Anyway, he earlier this week bought a ton of stock options with $80, with a strike price between $60 and $80. Obviously, given Bed Bath & Beyond closed Wednesday at $23, Cohen seems to think there's a bit of room to run here, and that is part of what was fueling these gains. Obviously, that's not all of it. A lot of these are trending on socials, and that's what's been getting the attention. A bunch of other meme stock favorites have been seeing little pops of gains here and there as well, but none on the same level as Bed Bath & Beyond the last couple of weeks. However, as we can see here, there's been a little dip, and that is because said Ryan Cohen actually made a filing, or revealed in a filing rather, in after hours trading on Tuesday, that he's looking to sell at least a large majority, if not all, of his stake in Bed Bath & Beyond, including some of his stock options. So that's obviously stressed a lot of people out into selling. However, the going back to Best Buy, I actually quite love these kinds of stories. I think they're hilarious. But as you can see, they had a little jump of 5% on Tuesday, taking them to their highest prices since like early May, I believe. And that is nothing to do with like earnings or anything like that. It's because people were getting the tickers confused between Best Buy and Bed Bath & Beyond. So as you can see, Best Buy is BBY and Bed Bath & Beyond is BBBY. Easy mistake to make, and very like reminiscent of the Zoom and Meta era. I don't know if you remember all of that, but these tiny like obscure companies were soaring because people thought they were investing in Meta or Zoom at their height. So always remember to check your tickers when you're investing, people. It will save you a lot of heartache in the long run. Interestingly, this revival of here's some news on Ryan Cohen and his filing. But interestingly, this revival of the retail trader has also meant that meme or day traders rather are pushing into the options market, which historically is actually not a good sign. So seeing this, analysts are warning that it could mean that the current rally we've experienced is more of a bear market rally than it is a bull market breakout, and that is historically what retail traders wading into the options market has meant. Obviously, there's no telling for sure, but make sure that you are remembering that everything that squeezes up is ultimately probably going to squeeze back down. So be careful out there. There's been a bunch of other news this week, including we have our Snaps page here, which you can check out, that has all of this and more. But we've seen Disney overtake Netflix in its streaming subscribers, which is a pretty big freaking deal considering Netflix is like the OG and Disney's still trying to find its feet in a way. We saw Rivian stick to its 2022 vehicle production target of 25,000 cars, which people weren't entirely sure they would, so that's good news for them. Peloton made a huge splash when it announced a massive overhaul of their business. They're cutting a bunch more jobs, cutting loads of their retail stores, and hiking their prices on their treadmills and bikes. Chinese tech giant Tencent saw its first ever revenue decline. And then we also saw the SEC going after Robinhood for market manipulation in the whole GameStop era. So go and check all of that out. Next week, we've got a bunch more earnings. Check out TradingView's earnings calendar if you want to see more. But we've got earnings coming from software brands and chip makers like Nvidia, as well as some discount shops like the Dollar Store and a few fashion favorites. So make sure you keep an eye out. And until we talk next week, always remember to look first and then leap.